Greetings, fellow traders. I'm Dylan, a research strategist at Pepperstone, presenting the latest weekly update on As Good as Gold. Over the past week, gold has been consolidating at high levels, with the bears seeming to hold a slight edge. Stronger than expected U.S. growth data and a rebound in the dollar index have put some pressure on gold, while the cooling U.S. core PCE, weak ISM manufacturing PMI, and China's still recovering economy have provided some support. Right now, all eyes are on Friday's U.S. non-farm payroll report, which could be the key to where gold heads next. As always, let's break down the technical analysis, recap the reasons, and look at the risks. Here we go. Looking at the daily chart of gold against US dollar from the past week, we see a bit of a retreat, with prices slipping below the 9-day EMA on Monday. This EMA has been providing solid support since August 9, marked by the green line on the chart. Since the critical $24.80 level has managed to slow down the bears, I still see the recent minor dip as part of a consolidation phase rather than the start of a downtrend. And if bears manage to push through and break $24.80, I'd be more cautious about bearish momentum building up. And I'd keep an eye on how prices react at the lower edge of the ascending wedge that's been forming since mid-February and around the 50-day moving average. While on the flip side, if the bulls take back control, I see $25.30 and the upper edge of the wedge as key levels that need to be cleared for more upside potential. In the short term, we've seen some economic data causing swings in gold prices. In the US, the second estimate of Q2 GDP came in at a solid 3% annualized growth, way above Q1's 1.4%. This upbeat data helped the previously oversold dollar regain some strength, attracting sellers in the gold market. Well, that said, I still think the actual state of the US economy might not be as rosy as this number suggests, and it might not last. Consumer spending is increasingly focused on essentials, while investment is mainly concentrated in the tech sector, leaving traditional sectors like utilities and construction in the dust. So to me, this doesn't scream market prosperity. Plus, with inflation cooling and unemployment on the rise at the moment, an economic slowdown seems inevitable somehow. Meanwhile, last week's August US core PCE data showed a slight dip from 2.7% to 2.6% year-on-year, with a 3-month annualized growth rate of 1.7%, the lowest this year. Even though the Fed's focus has shifted away from inflation control, this cooling in core PCE could strengthen the market's dovish expectations for the US interest rate environment through the end of the year. Add to that the ISM manufacturing index dropping into the contraction zone for the 5th straight month, with the new orders sub-index only at 44.6%, sparking concerns about future demand. And given worries over a US economic slowdown, traders seem to be holding on to gold, keeping its price elevated. And at the same time, safe haven demand is also coming from concerns about the Chinese economy, with properties still under the spotlight. New home sales from the top 100 developers in August dropped nearly 30% year-on-year. PwC saw massive layoffs after, Evergrande's collapse, and the New Work Group's stock price nosedived. The steady stream of bad news from one of the pillars of the world's second largest economy is keeping both domestic and international markets interested in gold, giving the bulls a solid foundation. So all in all, gold has been moving sideways at high levels over the past week, and I think the market's pricing of US and Chinese economic growth has been causing the short-term fluctuations. It's clear that the gold market is still waiting for a big catalyst to break out of this range, and I believe Friday's US non-farm payroll report might just be it. The consensus is for an additional 164,000 jobs, significantly higher than last month's 114,000, with the unemployment expected to dip slightly from 4.3% to 4.2%, and average hourly earnings likely to grow by 3.7% year-on-year. If job growth comes in below 100,000 and the unemployment rate holds at 4.3%, I think the market might start betting on a 50 basis point cut in September. This could heighten concerns about the U.S. economic condition, possibly pushing gold towards the $2,600 mark. While on the other hand, if the results are stronger than expected, a 25 basis point cut could become the default option, and the repeatedly placed in soft landing scenario might keep gold prices bouncing between $2,480 and $2,530. So that's pretty much all for this week. If you have any ideas on how the upcoming non-farm payroll data might impact gold trading, drop a comment below and let's chat about it. Stay tuned with Pepperstone for more insights and updates. And until then, happy trading!